Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do. And so we begin. Today is Wednesday, June 12th, 2024, and today's episode, if you use Yahoo Finance, notably, yesterday's bar for their daily bar chart was deleted. I contacted Yahoo themselves. They say they're, and I quote, engineers are working on fixing it, but they just deleted the whole day. I was, glancing through them a little bit and got quite confused. I hope the issue gets resolved. But that certainly is not very important as far as economic news goes. The main headline of the day really is that inflation is cooler than expected. So let's take a look at that data really quick down here, the CPI report for May. So the CPI, including everything, the month over month, last was 0.3%, expected 0.1%, actual 0%, so lower than expected. Year over year, last and expected at 3.4, actual 3.3, lower than expected. Core CPI, last and expected 0.3 was actually 0.2, lower than expected, and year over year, last 3.6, expected 3.5, and instead 3.4. I've been saying for weeks now that I've been expecting the actual data to come out to be lower and slower than what the markets are pricing in and what they're predicting. So far, that has been accurate. It's almost like that part of the curve where we are. If you remember, for a while, we kept expecting inflation to not be as bad, and it kept showing like, it's getting worse and worse and worse, up to 9%. And now we're at that point where things are cooling off a little faster than expected. The unemployment number was higher than expected. Things are slowing down. The other two notable things going on from the FOMC, CNBC, a quote from one of their articles: for the period through 2025, the committee now sees a total of 5 cuts equaling 1.25 percentage points, down from 6 in March. They were thinking they'd see 6 cuts, and now they're saying a total of 5. Also notably, the committee is seeing 1 or 2 cuts for the rest of the year, is what they said. And as I said yesterday, the Fed tells the Fed Funds Futures what to do, and then the Fed Funds Futures does what they tell them to do. And then, that gets priced in, and then this tells the Fed what to do, basically. Of course, it's all data dependent. Things can change eventually, and I think we are at that point where it's going to accelerate. I think the slowdown is going to accelerate here, but we'll see. Notably, for the September meeting, we now have a 57% chance of a cut. Really, it's closer to 63 if you add these two together, because there being a 5% chance of 2 cuts, that obviously this part of the probability is part of that probability. And then, by the end of the year, 1-2 cuts. So 42% chance of that. Again, it's actually higher than that, considering the percentages of the other potential cuts. Funny enough, we now have a 1% chance of, what is this, 4 cuts actually by the end of 2024. So that's interesting too. Next part of this episode, I'm just going to point out that I believe that no fear of the Fed is incorrect. I've been hearing now for a while many people saying that, oh no, the Fed's going to give in before we get down to 2%. I was able to listen to Jerome Powell talk himself today, and it sounds, he sounds like he's being kind, but he's not being kind. He's waiting for inflation to get down to 2%. I believe it was just the last meeting, they said we're not seeing enough progress towards that goal. And then this time he says, okay, we're seeing some progress. But at the end of the day, it doesn't matter what they even think in terms of like how they feel about it. At the end of the day, I do not believe they're going to be cutting until we do get down to 2%, maybe even lower than 2%, or at least like directionally like headed straight to 2%. My whole take on this is that we've switched from a deflation fear mode to an inflation fear mode. And I believe that it will drive, this is my own words here, I believe it will drive policy until inflation is securely below 2%. Or, as I said, very obviously like collapsing towards 2%. So, why do I think that the Fed is going to be more hawkish here? Well, here's my reasoning. A, higher, stickier rates allow a longer runway when we are currently in an environment where our current president actually just came out. I don't know if you saw in the news, he wants to seal the border. That's part of this demographics that basically lead to, the birth rates are low. The only thing keeping demand up is maybe, if you have more and more people coming into your country, well, that can help keep demand up. But once that's gone, what are we left with? We're still left with the same demographic issues that we had before. And that's going to lead to more disinflation and deflation. And so the longer term goal, I believe, of the Fed is to create that longer runway where they can cut rates maybe even slower than they normally would. Because at the end of the day, I do think that an average of 2% over time means that under 2% for some time should be okay by that definition. Will it play out that way? I think it will. I think, I think it would be sensible for that to happen. I don't think having an inflation rate below 2% is dangerous. There's been periods of actual deflation where CPI is negative, where the whole world didn't completely fall apart. I mean, outside of the Depression, we've had plenty of disinflation and deflationary moments that did not, kill the entire economy. And I think we're there. I think, the fear, I think most people, everybody is feeling the same thing. With inflation being so high for so long, we need it to go the other way. And I think that's what the Fed is going to be doing here. So the third reason, I was going to do something else, but I'm not going to do that anymore. Deflation mode versus inflation. Deflation fear mode versus inflation fear mode. And I want to get to a chart. Before I get there, because I'm not going to go back to this page, I'm just going to note tomorrow and Thursday, we're not done with the data coming out, even though we had CPI and FOMC meeting today. We have PPI coming out tomorrow, which can still affect things. So here I have two charts on top of each other, screenshotted from the Fed. The first one shows blue and red lines, the blue line being consumer, the regular CPI, so how much stuff costs. Is it getting more expensive? And these numbers over here, 5% a year, 2.5% a year, so that's overall CPI. And then the core CPI, which is less volatile, all items besides food and energy. And the bottom chart here is the Fed's funds rate. So this is this whole thing. When they're tightening, this blue bar goes up. When they're easing monetary policy, they're doing the cuts that everybody's hoping for, this line goes down. And the typical cycle is they hike, and then they start cutting, and then we have a recession, and then we cut through here. We hike, we have a recession, and we cut, and then things are okay. We hike, we stay flat, and then we start the cutting, and then all of a sudden a recession, and then cut, back down to zero. We hike, and believe it or not, a lot of people still don't realize we cut before COVID was even known about. We actually were cutting, I believe it was the end of 2019, before there was even a whisper of COVID. We didn't cut just because of COVID. We were already cutting before that had happened, and we had our little mini recession, and then massive fiscal spending, and all while inflation is going higher, and then inflation did spike here, and so we went up, and now we're holding steady. Now, as you can see from this chart, the Fed doesn't, people talk about often how the Fed has been like cutting and cutting since 1980 basically, and yes, that's sort of true, but they also have had hiking cycles, and they pretty much keep it high until they see a problem, and until things slow down. It's not like they're gonna cut early out of this, especially after everybody has been experiencing such bad inflation. The Fed had a very large hiking cycle. Even just look back, we haven't been this tight since 2007. Not only that, where did we start? We started at zero. In 2004, 2005, we were actually more around 1% before hiking to that height. This was the rate was, and the height of this raising cycle has been extremely aggressive, and they're staying flat, until these bars up here go down further, period. Zooming into the CPI reports, the red line is the less volatile one, and to my eye, this is no longer going flat. This is decisively going lower here. The lowest reading we've had of recent months was in February, when the core was at 3.76, and now it is at 3.62. The rate that it has been slowing has decreased, but the direction has not changed. It is still dropping. Moving on to some charts, the S&P 500 has a closing all-time high. The stock market jumped up pretty dramatically today with a large topping tail, which can be seen as a bearish reversing signal. But, admittedly, I had called the top back in May. I called the top again earlier this month in June, and yet we are now at another higher high in the S&P 500. The truth is, as far as patterns go, this is starting to actually look more bullish. When you have a jump up like this, if it drops a little bit, there's likely to be buyers here that will keep sending it higher. How many buyers are there at these levels, and how high will it and can it go? I don't know. Stocks are too expensive for me right now, considering earnings. If you haven't seen my show from Saturday, I believe it was June 8th, for some reason I got way more views on that. It was like 680 views. I normally get only 30 or 40. But it was one of my better shows, which is why I think it got more attention. But in it, probably the best part of that is where I go through the earnings of the S&P 500 and the price. Moving on for today's chart, the VIX had a pretty large engulfing candle to the downside. The overall market is just calm. It's calm as can be. Giving more support and legs to the market, HYT, high yield corporate. I have been talking about now for the past week or two how this has been coiling up, and I'd be very interested to see if it breaks out. I was expecting it to break out to the downside. Instead, we broke out to the upside, and so this is giving legitimate legs to the stock markets at this time. I don't know how long it'll last, and I don't really care. The way I see markets right now still, and I don't know how long I'm going to be saying this for, but I do see it still as a game of musical chairs where, it's all fun until the music turns off. But for today, the music looks like it's playing. Notably, XHB, Home Builders Index, we've been in sort of a channel. This has been a methodical market, just going up and down. We had quite a big gap up today in the value of XHB. Moving on, Fear and Greed Index at a level of 47. Yesterday was at 46. So according to this way of gauging fear, we're only slightly less fearful, just a little bit more towards neutral today. I wanted to bring up TNX, the 10-year Treasury yield, dropped fairly dramatically today. I had mentioned in previous shows that we pushed the first cut from September to November. That's getting smoothed out a little bit just because it seemed like Powell, he's open to the idea of 2 cuts. And so now the higher probability is actually the first cut being in September, according to the current narrative as of today. So because of that cut looking like it might be earlier, I think that gave a lot of pressure off of treasuries. Being underpriced is the best way that I would put it. I still expect rates to be going down from here for good reasons and for bad. It's like, it's really funny how, bad news causes yields to go down and treasuries to go up, and then those yields going down give weight to the stock market, so the stock market can just happily keep rising up until the bad news is bad enough and people start running away from stocks because they realize that the earnings aren't going to be keeping up or maybe even contract. And when things are really slowing down, people pile into these same treasuries, driving the yields even lower and driving the price of the treasuries up even higher, which is why I'm continuing to say that I believe the safest place for investment right now and speculation, it's both. Everything combined, I think the best place to be is TLT, or what I like is the 0Z, TMF, things that have a little bit more leverage to them, but that's where I'm at. Similarly, obviously, in the 30-year Treasury yield, seeing a pretty good drop today from yesterday's. See what I mean here? If you can see it at the bottom of the page, they deleted June 11th. So anyway, from the 10th, it was at 4.6%, dropping all the way to 4.45% today. But careful with those Yahoo charts. Obviously, TLT had a nice bid, pretty good jump up in value today off of all of this news. Also notably, SMH, at this point with the valuation of this thing, what did we go up? 3% in this index today. I'm going to refer to this as dumb money at this point. Benjamin Graham notes in several of his books, now I'm finding out, that hot stocks, hot places to invest, the place where your cousin and your neighbor made tons of money, to chase that is, it often ends in disaster, which is a game I'm not willing to play. And I'm happy to sit here and watch it float up to the moon and have it come back down again. I could see myself investing in semiconductors in the future if the valuations start to make any kind of sense to me, but not for now. That's all I have for you today for today's episode. I hope you enjoyed. Thank you for watching. Rob's Child.